I want to talk about the role of the Fed in the future of the financial services regulation, if you like. That's my particular responsibility in this panel, the role of the central bank as we reform the financial services industry in the future. I think you could say there's kind of three possible roles, if you like, that people are discussing or that are happening already or that may have happened in the past. So I want to just think about those three. One is that the Fed become a systematic risk authority, a systematic risk authority. And the chairman of the Fed just had a speech about this just this week on the 10th. And what that means, sometimes it's called a macro-prudential, sometimes called market stability regulator. Secretary Paulson in his proposals called it a market stability regulator. What this would mean is that the Fed would not only have responsibility for regulating the institutions that it does now, the depository institutions, but also have responsibility for, if you like, overall risk. So if there's the financial system is too much invested in one industry, might make comments on that. Or if there's too little capital in general, might make comments on that. These are just examples. No one actually has specified exactly what a systemic risk authority would do. But that's the general idea, and it's under discussion, as I say, proposed by a number of people in leadership responsibilities. The second thing you could imagine the Fed becoming is what it is now, actually, and that's what I will call a selective credit authority. And that's where it's purchasing certain kinds of assets, commercial paper, mortgage-backed securities, securities backed by student loans, or making loans to particular financial institutions, AIG or whatever it happens to be. And that's in a sense where we are now, and I'll try to describe that a little bit. There's certainly possible that it would continue that way in the future. The third possibility is that it becomes a monetary authority. And actually, I hope that's what it does become again, because in some sense, that means getting back to the policy that existed and operated quite well before this whole mess in the financial crisis began. That's where the focus was on keeping inflation low, keeping overall stability, following an interest rate policy, which some people call the Taylor rule, but it doesn't matter what you call it, it's really worked well. That kind of response has worked well for a couple of decades until they got off track. So let me actually try to explain my position a little bit with some charts. There, this is the first chart. I don't know how many of you heard Paul Romer's talk this morning, but he had a graph. He started off looking a little bit like this. It was for thousands of years. This isn't even 1,000 days. And it shows you the amount of money, if you like, created by the Federal Reserve in the latter part of 2008, basically. This measure is simply the reserves that banks hold at the Fed. It's part of what is base money, and it's really what creates money in the overall system. When we teach economics of banking to our undergraduates, we say the first thing you do to increase the money supply is you purchase assets so that the reserves at banks increase. So this is actually a fundamental measure of the impact of monetary policy. And you can see that it increased last fall from 8 billion to 848 billion at the end of the year. So that's a 100-fold increase, and it's huge. And that's, in a sense, where the Fed is. If you look way over on the left around 2001, in fact, September 11, 2001, you see another blip. At that time, we talked about how amazing that blip was. It was like unprecedented at the time. It was so gigantic. But now it's like a little pimple. So anyway, so now why is this exploding? Is this quantitative easing? No, it's much more than quantitative easing. It's a way that the Federal Reserve is financing its activity in the credit markets, okay? What is its activity in the credit markets? This is a long list. Obviously, I'm not going to get through this, but just look at the red. When a year ago, if I were teaching money and banking to Stanford undergraduates, I would talk about basically the things that are in black: securities purchases, repurchase agreements, repos, and then, of course, occasionally making loans to banks through the discount window called the primary credit facility. But during the crisis, the number of facilities has skyrocketed, and starting with the loans from the so-called term auction facility and expanding loans to primary dealers, broker-dealers, and then a special facility to make loans so that people could buy assets from money market mutual funds, of course the loans to AIG, which are very famous, and it goes on and on. There's also, those are direct loans, the rest would be, if you like, purchases of private securities like commercial paper, like the old assets of Bear Stearns, like some of the assets that was hanging around AIG at the end. And most recently, at the bottom of the list, right before you see loans to foreign central banks, which is very large, you see the latest, which is the proposal that the Fed engage in the purchases of consumer and business loans. That's a proposal that Secretary Geithner made on February 10th, basically $1 trillion initiative where the Fed would finance those purchases. Okay? So it's a different Fed, different activity completely. And just to be sure, what does this have to do with this big increase in money? Well, just like anyone else, the Federal Reserve has to finance its purchases. It has to finance its purchases. It could borrow, it doesn't borrow. It could have the Treasury borrow and deposit the money at the Fed. It does a little bit of that, raises questions. Or it could just create the money itself, which is what it has been doing, and that's a description. Now, one thing, just one more chart. This is my attempt, and it requires, I suppose, you're not colorblind, but it's really a description of all these different activities as best as I can. Obviously, when you got 15 different entities, transparency itself becomes a problem to describe it well. So I started last December trying to document what the Fed was doing with graphs like this. And you can see, for example, the green things expanding. Those are the special new loans to banks. You can see the purple thing, that's the new private portfolio. It'll be commercial paper. Now it's going to start going into mortgages. And you can see the yellow is the loans to foreign central banks. So the idea is to simply just track so that people know what's going on. Fortunately, last week, the Fed created its own website, which is putting this kind of information up. So I think I may not be doing these charts anymore, which is very good, by the way, good for transparency. Okay, now one more picture, and then I'll. There it is. Okay. This is my last picture, and then I'll just give a few more comments. This is the same picture I showed you at the beginning, except it projects what might happen the rest of this year with respect to money, if you like, money creation. So that red line that's up there, that's the amount of reserves, if you like, that the Fed would create if it financed the $1 trillion of purchases of credit card debt and other kinds of consumer loans, business loans, et cetera, through the Business and Consumer Lending Initiative. Okay, so it's huge. It takes you therefore up to around $2 trillion from $8 billion in the beginning. But what's the problem with this in terms of the future? Well, first of all, inflation. You look at that number there, and if that expands, as it ultimately will, into the whole money supply, you've got a huge inflation problem down the road. You just can't print money like that and hope it never creates inflation. We know for many, many studies over many, many years in many, many countries it will cause inflation. Now, what does the Fed say about that now? Well, they say, don't worry, we'll pull it out.